/CHN. Good morning, everyone, and welcome to today's market analysis. Let's begin with a look at the U.S. markets yesterday, where the three major indices closed mixed, indicating a complex sentiment among investors. The Nasdaq Composite ended the day at 27,093.90 points, the S&P 500 at 7,609.78 points, and the Dow Jones Industrial Average at 51,307.79 points. All three showed a 0% change, essentially flat for the session. However, post-market futures revealed a clear divergence. Nasdaq futures saw a slight increase of 0.1% to 30,726.00 points, while S&P futures dipped 0.15% to 7,608.50 points, and Dow futures dropped 0.26% to 51,213.00 points. This suggests a mild preference for the technology sector, but an overall cautious outlook regarding the broader economic prospects. On the individual stock front, there were no significant unusual movements yesterday. Prominent names like IBIT, QQQ, SPY, Nvidia, and Tesla all showed no change in their prices, further indicating a lack of clear directional catalysts in the market. Now, let's turn our attention to the global macroeconomic landscape. The 10-year U.S. Treasury yield currently stands at 4.49%, marking a 0.76% increase. This is a clear signal of tightening liquidity, which naturally puts pressure on risk asset valuations. The VIX Volatility Index, often called the fear gauge, rose to 16.25, up 3.04%. While still within what we consider the normal sentiment range of 15 to 25, the rise in risk aversion is quite evident. The US Dollar Index, DXY, is at 99.45, up 0.16%. A stronger dollar typically exerts downward pressure on emerging market currencies and capital flows. In the oil market, WTI crude is trading at $95.49 per barrel, up 0.45%. This surge is primarily driven by geopolitical conflicts in the Middle East, with reports of an Iranian attack on a U.S. military base in Kuwait leading to a jump in oil prices. Spot gold is at $4,492 per ounce, showing a marginal decrease of 0.02%. Its safe haven attribute doesn't appear to be fully ignited, possibly due to the general tightening liquidity conditions dampening gold buying. Overall, with rising U.S. Treasury yields, a stronger dollar, an uptick in VIX, and escalating geopolitical risks, global markets are clearly in a risk-off state. Let's examine the renminbi and the external environment for Chinese assets. The onshore US dollar to renminbi exchange rate is at 6.7687, and the offshore rate is at 6.7739. Both have seen a slight uptick, indicating increased short-term depreciation pressure on the renminbi. A weaker RMB directly impacts foreign investors' willingness to enter the market, suggesting a higher probability of net outflows from northbound funds today. Regarding U.S.-China trade friction, the U.S. Trade Representative's Office, USTR, issued a federal notice on June 2, seeking public comments on a mechanism to promote balanced and reciprocal trade with China, aiming to adjust tariffs on non-sensitive products through the U.S.-China Trade Council. Simultaneously, the Trump administration has proposed imposing additional tariffs of 10% to 12.5% on 60 economies, including China, citing concerns over forced labor products. China has explicitly opposed these unilateral tariffs. China itself is also preparing a technology export control list covering 63 technology fields as a retaliatory measure. These developments undoubtedly add to the uncertainty in U.S.-China relations, suppressing market risk appetite. For the A-share market today, our pre-market sentiment forecast points to a slightly lower open. The combination of external macro pressures, RMB depreciation, and escalating U.S.-China trade friction will undoubtedly weigh on early trading. However, yesterday's strong performance by the Chi-Next board might offer some buffering effect. Specifically for today's A-share market outlook, in terms of index direction, the Shanghai Composite is likely to show a weak, volatile trend today, pressured by external macro risks and intensifying US-China friction. The Chi-Next index may also experience slight downside volatility. Despite its strong performance yesterday, funding pressures and market risk aversion will limit its rebound potential. For leading sectors, the communication sector is most likely to be active today, particularly optical communication, CPO, and AI computing power concepts. There are three reasons. First, the communication sector led yesterday's gains with a 4.78% increase, demonstrating strong momentum. Second, there are intensive industry catalysts, with the Beijing Optical Network Seminar and the Shanghai CPO Asia Conference running concurrently, reinforcing short-term sentiment. Third, the long-term logic driven by AI computing demand remains unchanged. Investors should be mindful of risks. Export-oriented and trade-sensitive sectors should be avoided. The expectation of RMB depreciation will increase foreign exchange losses for export enterprises, and the proposed U.S. tariffs will directly impact related industries, while escalating US-China friction also dampens investor confidence. Regarding northbound funds, a net outflow is more probable today. The stronger dollar, RMB depreciation, and external risk-off sentiment collectively encourage foreign capital to withdraw from emerging market assets. In summary, the upward movement in U.S. Treasury yields and a stronger dollar are exerting significant pressure on the market. Even the independent strength we've seen in A-shares technology segment might feel the impact, leading to a volatile and fragmented market. Our probability assessment for today is a 25% chance of an upturn.